All right, let's jump right into it. In today's explainer, we're taking a really hard analytical look at a fascinating turning point in the automotive and alternative asset markets. We're investigating the hidden financial vulnerabilities of the modern hypercar industry, and we're specifically zeroing in on the data surrounding the highly publicized Bugatti Tourbillon. Now, on the surface, the hypercar market looks completely invincible, right? It just seems like this playground of infinite capital. But the data from our sources tells a completely different and honestly a pretty alarming story about structural fragility. We are going to break down the cold, hard facts behind a potential market collapse and then contrast all of that with the ultimate physical asset. So, this is the central mystery we're unraveling today. Seriously, what actually happens when a brand that is widely considered the absolute crown jewel of the automotive world might in reality be teetering on the edge of a massive financial cliff? I mean, how does a billion-dollar valuation hold up when you look under the hood of its balance sheet and find out it is essentially running on unsecured debt? To really understand this, we have to look back at an inciting incident that sent absolute shockwaves through the industry, even if it barely made a blip in the mainstream headlines. Section 1. The Porsche exit. Okay, let's dive into this. The spark that lit this entire powder keg happened back in April 2026, and it involved one of the most calculating, risk-averse corporate giants in the world. On April 24th, Porsche AG quietly sold off all of its shares in Bugatti Rimac to the Hof Capital Consortium. Now, the public relations spin on this was masterfully crafted. They framed it as a move toward brand independence and agility. But let's look at the actual ledger reality here. Porsche didn't just sell its shares, they systematically severed all technical support and legal intellectual property guarantees. By doing this, Porsche mathematically shielded themselves from future recall liabilities and unwound a massive risk exposure. When a guarantor of that magnitude quietly exits the building and takes its safety net with it, we absolutely have to ask why. Section 2. Financing the hypercar illusion. To answer why Porsche fled for the hills, we have to look directly at the cold financial data. And that brings us to this truly staggering number, $800 million. This represents the estimated customer deposits calculated directly from the 250 reservations for the new Bugatti Tourbillon. Now, $800 million might sound like an incredibly healthy war chest, but there is a critical, highly dangerous caveat here that completely flips the financial reality on its head. The actual structure of this valuation is what's truly alarming. That $800 million, it is not sitting safely in some locked escrow account. It represents 80% of Bugatti's estimated $1 billion valuation, sure, but it's currently acting as immediate working capital. Our sources indicate this money is being burned right now to fund the Cosworth V16 engine development and to plug operational gaps across the wider Rimac group. So investors and customers are unknowingly funding this crazy high-wire act, using future liabilities to pay for today's engineering. It is literally an inverted financial pyramid. And making matters worse, this high-wire act is taking place during a massive macroeconomic storm. It's the exact squeeze that forced Porsche's hand in the first place. On one side, you've got supply chain hyperinflation. We're talking a 180% price surge since 2024 for things like high-purity titanium and sapphire glass. And on the other side, you hit the physical barrier of U.S. Section 301 tariffs, which creates a maximum 35% effective rate on EU high-tech auto components. Look at the fallout. In 2025, Porsche absorbed a 92.7% operating profit drop, plus massive special losses due to those tariffs and general market stagnation. Supporting an unprofitable hyperniche under these exact conditions just became mathematically impossible. Section 3. The digital obsolescence trap. But let's say they do survive the current macroeconomic squeeze. The cars themselves are still battling a ticking clock of digital decay. It's this ultimate clash between digital fragility and enduring craftsmanship. The Tourbillon utilizes highly advanced AI-optimized 3D printed components. Incredible tech, right? But they're extremely disposable. A single stress fracture can render an entire structural component a total loss. Compare that with enduring craftsmanship, artisanal metalwork that can be repaired infinitely by a master metalworker. And yes, the Tourbillon boasts this beautiful 650-part Swiss mechanical gauge cluster. But our sources argue this is really just borrowed prestige. It's a visual distraction designed to mask the impermanence of its underlying digital core. Because the crucial point here is what actually happens to that digital core. The vehicle relies entirely on proprietary software and authentication keys that are centralized on the manufacturer's servers. And research shows that standard server deprecation, or just straight-up corporate insolvency, guarantees a paperweight horizon within roughly 15 years. That is about 1/5 the lifespan of the physical hardware itself.
Once it is severed from that digital umbilical cord, decentralized offline maintenance is basically impossible. The asset instantly becomes a multi-million-dollar unrepairable brick.
Which leads us to a fundamental redefinition of the asset class itself. Think about it. A modern hypercar like the Bugatti Tourbillon is essentially just a digital credit contract. Its entire value and operability depend completely on the survival and the continuous support of the issuing corporation. Contrast that with a vintage V12 Ferrari. That functions as a sovereign physical resource. It is a totally independent entity whose value is intrinsic to its physical form, completely and utterly disconnected from the fate of the original manufacturer.
And if you're sitting there thinking a brand name guarantees safety, well, history proves otherwise. This chart tracks the ghost of Campogalliano, the 1995 Bugatti EB110 bankruptcy. Back then, there were zero refunds for unfulfilled pre-orders. Following the bankruptcy, secondary auction prices absolutely collapsed to under 30% of the original MSRP. It literally took 25 years of market amnesia for that asset class to recover its multi-million-dollar valuations. The data strongly suggests we are watching this exact architecture of failure repeat itself right now.
Section 4. Mobile Bullion. The counter asset. Okay, so if modern hypercars are fundamentally flawed, where does strategic capital actually go? The solution is the ultimate safe harbor asset. In an era of central bank digital currency tracking and rapid fiat inflation, a heritage 1960s V12 Ferrari functions basically as off-grid, physically transferable gold. It is quite literally mobile bullion. It's a bearer asset that relies on absolutely zero digital infrastructure to hold its value or, to actually operate. The absolute beauty of this physical asset is its mechanical eternity. A vintage Ferrari doesn't need the original manufacturer to survive in order to keep running. Because it relies on natural physics rather than encrypted code, all it takes is a set of blueprints and a heavy iron mechanical lathe. I mean, so long as metal exists on this earth, the asset can be maintained, tuned, and rebuilt indefinitely. When we map out and synthesize this asset DNA, the differences are just profound. Look at scarcity. For a tourbillon, it's totally artificial, capped by a marketing department. Scarcity for a vintage Ferrari is natural, capped by actual historical production. Maintenance for the modern car is centralized and strictly proprietary. For the vintage car, it is decentralized and beautifully physical. The modern car has that 15-year lifespan limit dictated by software deprecation, while the vintage car boasts infinite mechanical rebuildability and a century-long proven global market for secondary liquidity. Section 5. Strategic Capital Reallocation. Understanding this fundamental difference in asset DNA completely requires a shift in strategy. So here is the clear 3-step rebalancing plan from the sources. Step 1. Immediate halt. Liquidate positions or cancel unescrowed deposits for digitally dependent hypercars right now to avoid the evaporating liquidity trap. Step 2. Consolidate heritage. Redirect that capital toward the meticulous maintenance and verification of matching numbers 1960s V12 Ferraris, safely securing your mobile bullion. And step 3, if you absolutely require a modern allocation, utilize modern alternatives that actually have a proven lineage of mechanical continuity, like the Ferrari 12 Cylindri, effectively avoiding those artificial digital traps altogether. I want to leave you with this really profound final thought, taken directly from our source analysis. The absence of soul you sense in the modern hypercar is fully corroborated by the cold financial data of 2026. Do not fund the second coming of the EB110. It's a really stark reminder that true luxury just isn't found in fragile digital promises. So you have to ask yourself, in the long run, are you holding an enduring physical asset, or are you just holding an expiring digital contract?